Hey everyone, welcome back to Corporate Dakota. Today I just filed an 8K detailing a significant debt offering, and I am seeing a clear strategy emerging. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is raising a lot of money through new debt, and understanding why is key to what might happen next. So, what is this filing all about? Alexandria Real Estate Equities, Incorporated, or A.R.E, is a big player in real estate, particularly focusing on office spaces. They are filling out a form called an 8. Think of an 8K as a company's way of telling the public about big, important things that happen outside of their regular financial reports. It is like a news flash from the company. This particular filing is about a major financial move. A.R.E announced a big debt deal. They are selling notes, which is basically like borrowing a lot of money from investors. Specifically, they are issuing $1 billion worth of these notes. These aren't just any notes, they are called junior subordinated notes. That means if the company were to run into serious trouble, the people who hold these notes would be paid back after other, more senior debt holders. The interest rate on these notes is set at 7.250%, and they are due in 2057. That is a very long time away. This tells us A.R.E is looking for long-term financing. Why raise so much money? Companies usually do this to fund growth, make acquisitions, refinance existing debt, or for general corporate purposes. Given the amount and the long maturity, it is likely they are looking to expand their portfolio of properties or perhaps refinance older, more expensive debt. The fact that they have an effective shelf registration statement on Form S-3 on file with the Securities and Exchange Commission suggests they have been planning this kind of offering for a while. It is a way to be ready to issue more stock or debt when market conditions are favorable. They have brought in some major banks to help them sell these notes. Names like JP Morgan, BofA Securities, Citigroup, Goldman Sachs, and RBC Capital Markets are all very well known in the financial world. Having these underwriters involved suggests confidence in the deal and helps ensure the notes find buyers. The timing of this offering is interesting when you look at the broader market. Alexandria Real Estate Equities is a real estate investment trust, or REIT, that focuses on office buildings. The office real estate market has faced headwinds recently with the rise of remote work. However, Arkansas E is known for its high-quality properties, often in prime locations. And it has a history of strong tenant relationships. This debt issuance might be a move to solidify their financial position and continue acquiring or developing premium assets despite market uncertainties. They also put out a press release to announce the pricing. This is standard practice to inform investors about the terms of the offering. The fact that they are issuing debt rather than equity is important. When a company issues more stock, it dilutes the ownership of existing shareholders. Issuing debt, however, increases the company's leverage but does not directly reduce the ownership stake of current investors. Looking at the details, the underwriting agreement itself is a key document. It lays out all the terms and conditions of the sale between the company and the underwriters. This is a complex legal contract, but the core message is that the company is selling $1 billion in debt. The press release provides a more digestible summary for the public. We see that the notes are unsecured and guaranteed by Alexandria Real Estate Equities, LP, which is likely the operating partnership of the REIT. This means the parent company is backing the debt. Finally, there is the interactive data file. This is part of the SEC's push for more digital and machine-readable financial information. It essentially tags all the key data points in the filing so they can be easily analyzed by software. Now, let's consider the implications raising $1 billion in debt signals a significant strategic move. For A.R.E, this could mean they are confident in their ability to generate enough cash flow from their properties to service this new debt. The 7.25% interest rate is not insignificant, especially when compared to historical lows, but it reflects the current interest rate environment and the risk profile of these junior subordinated notes. If we compare this to other rates, especially those in office spaces, Arkansas E seems to be taking a proactive approach. Many REITs have been cautious, but appears to be betting on the long-term value of its high-quality assets. One historical parallel to consider, though not a perfect match, is how companies in cyclical industries might raise significant debt during perceived downturns to secure capital at favorable rates, preparing for a future rebound. For example, when interest rates were rising a few years back, many companies rushed to refinance debt. While this is not a refinancing, it is a similar strategic move to lock in rates for a long period. The risk here, as always with debt, is the company's ability to repay it. If property values decline significantly or tenant demand falters more than expected, servicing this debt could become a challenge. However, Arkansas E's focus on premium properties and long Term leases generally provides a more stable revenue stream compared to REITs with more commoditized or lower quality assets. The biggest concern I have is the long-term nature of the debt in a potentially volatile real estate market. While the 7.25% rate is fixed for now, the reset feature in the note's name. Fixed to fixed reset rate suggests there might be periods where the rate adjusts, though the filing specifies it is fixed to fixed, implying it stays fixed at 7.25% until maturity. This is a crucial detail for investors to scrutinize. What I am actually looking for is how this capital is deployed. Will it go towards new acquisitions that offer strong returns, or is it primarily to shore up their balance sheet? The strategy behind deploying this $1 billion will be the true test. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like this video. Comment your thoughts and subscribe for more. See you in the Discord.